You found a good multifamily deal, you have a plan to improve the property, and now you have to work out your profits and what you're going to sell it for. This is where exit cap rates come into play, and in this video, I'm going to walk you through how your exit cap rate selection can affect your projections. So make sure you hit the subscribe button right now so you don't miss more videos about building wealth through multifamily real estate. And if you don't know me, I'm Seth Ferguson, a 12-year real estate veteran, host of a real estate TV show, host of a real estate investing podcast, and the author of the real estate book, Sell for More. So let's get right into it and talk about exit cap rates. And commercial real estate is valued using what's called the income approach. And if you're not familiar with the income approach, I'll put a link right up here to my video that walks you right through it. In a nutshell, the income approach uses the property's NOI, or net operating income, and a cap rate to figure out the property's value. And when we're doing our projections, looking ahead into the future, this is a little bit tough because nobody has a crystal ball, at least a working crystal ball. If you do have one, let me know, and we'll do a deal for a couple $2 billion and we'll all get rich. We're really making assumptions about a future selling environment, and one of the assumptions we have to make is the exit cap rate, and this is also called a terminal cap rate. This is the cap rate that the market's going to be using to value the net operating income produced by our property at a future date when we go to sell. A big mistake some investors make is being too aggressive with their exit or terminal cap rates, meaning they've based their entire project on these projections that are just fairy dust. They're not grounded in reality. So by the time they actually go to sell for real, the exit cap rates they're expecting are nowhere to be seen, and then that's where all their projected revenues, all their projected profits just evaporate into the air. They were never really there in the first place, they were just on paper because they were too aggressive with their exit caps. I would much rather be safe than sorry, so we need to be conservative with our exit or terminal cap rate. But where can we come up with some material and data for our estimation for our future selling environment? One place to look is historical market data and how your market has fluctuated. What are the swings like, the ups and the downs? Look for over the past 10 years, 20 years, even 30 years, and try and find some patterns and then project ahead for that. Another thing is you want to look at key market drivers. What is driving the market? Is there a long-term trend of a decreasing cap rate, meaning that investors are willing to pay more for each dollar of NOI produced by a property? If that's the case, things are looking pretty good, but you still have to be really conservative. So let's take a look at an example that will show us the difference that a cap rate can make. For this example, let's assume we're taking a look at a 200-unit property that produces an NOI, or net operating income, of $2 million. Now, how does this $2 million NOI get affected by an exit cap rate? Well, let's say we are using an exit cap or terminal cap rate of 4.5%. The value of that property that we are projecting is $44.44 million. Not too shabby. Then when we bump up the cap rate, so as we go up in our cap rate, that means investors are willing to pay less for each dollar of NOI produced. So a 4.75% cap rate, that will yield a value of $42.1 million. And then at a 5% cap rate, we have a value of $40 million. You can see how the slightest difference in exit cap rate can make a big difference. We have an 11% swing, or a $4.5 million valuation change from a 4.5% cap rate to a 5% cap rate. Now, this is why I was saying that all your profits can go up in smoke because they're fairy dust if you are too aggressive with your exit cap rates. I would much rather be conservative and project a 5% cap rate even if I'm purchasing at a 4.5% cap rate, because I never want to assume that the market will be as good as when I purchased. I would much rather project a softer market and less of a return of on each dollar of NOI, so that way I can actually budget ahead and plan ahead. If I do sell at a 4.5% cap rate, that's just gravy and I do a happy dance. But if not, I don't want to be surprised down the road when the market actually values my NOI using a 5% cap rate, even though I was thinking all along and promising all my investors that we were going to sell at a 4.5 cap. So I hope you found this video useful, and if you're interested in learning more about the deals I'm currently looking at, head on over to callseth.com and set up a free 20-minute phone call with me. And if you like this video, if you found this useful, hit the like button, leave a comment, let me know what you think, and until next time, happy investing.